Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us as we come to you each and every week with information that might help you decide whether you want a mortgage, what cost the mortgage might be, maybe some real estate questions that you might have, how, in fact, I, as a buyer, am going to pay for a real estate agent when I basically can't seem to afford a mortgage. Yes, it's a big question, especially nowadays when that lawsuit went through and the NAR settled. I don't want to get in too heavily on that, but there are some changes that you have to take into account this time, this year, if you go out there and you're looking for a house. Obviously, prices are what they are. They're high, right? I mean, everybody knows that. And we also know that the mortgage interest rates are also high. Both of these things together make your job difficult, which is why thinking about the commissions and the guy who or gal who's got to come and help you as a real estate agent, yeah, you got to think about these things and figure out the best way to get the most experienced person at the least amount of price. It's kind of like buying a house, right? You want the best house, the cheapest house in the best location. And usually that, you know, in this market where in California, I guess Southern California, the median house costs about $760,000. That's a lot of dough. I mean, if you look across the country about other things that are available out there, whether it's in South Carolina, whether it's in South Dakota, for that matter, or New Mexico. I mean, there are house prices, they're $300,000, $350,000. Well, we're twice that plus. Southern California is a tough market to buy into. Most people that do live here for a long time have owned their house for a generation, maybe two, and the house gets passed down one person to another. There's the lock-in rate that is an issue. Of course, everyone knows about that. I got a 3% mortgage. Why am I going to sell and get a 7% mortgage? Anyway, I'm Jeff Barton. This is The Mortgage Voice. If you want to see and hear this show, as well as past shows, 10 years of past shows almost, anyway, go to YouTube, Jeff Barton, The Mortgage Voice. That's our YouTube channel. And as I said, we've been there for hundreds and hundreds of shows. It's a great place to get an education as to what's been happening on a weekly basis for all that time. We don't always get it right, but we usually correct what we said in previous shows on shows that come up. So if there's something that you need to know more information about, you can always call us. You can always email us. And we also have a terrific website that you can go to and contact us that way. It's themortgagevoice.com. And when you go there, you can see our guests, past guests, guests that are on the current show, and you can contact them directly, or you can, email them or call them or listen to them again. I'm Jeff Barton. This is The Mortgage Voice. And again, thanks for tuning in. Let's get right to it. It's a little business of the show that we like to get to. The interest rates. The interest rates have been changing, fluctuating a little bit, but they've hovered around 7% for the last 3-4 weeks. 7.03% is the 30-year fixed rate. 6.44 is the 15-year. 6.48 is FHA. 7.25 is the jumbo. And 6.49 is the VA. The 2-year is at 4.736, and the 10-year is at 4.238. You know, that spread that I always talk about and have said for, a number of years, that this portends what's going to happen in the future, whether it's going to be a recession or whether we're going to, get out of the recession. Well, it comes up again and again and again. It's like the market doesn't seem to want to let go of this old adage that if we have an inversion in the yield curve, the 2 years, I said, is at 4.7, the 10 years at 4.2, meaning that if you invest short-term, you'll make more than if you invest long-term. That's an inversion, right? That means it's opposite of what it normally is going to be. Well, as a result of that, people have it in their heads continuously. Economists, people who are old school, anybody who has followed economics through the last 10 recessions will say that prior to that recession, you have this inversion. The 2-year makes more than the 10-year. Well, we've been at this inversion at this current time for about, it has to be 15, maybe 20 months, almost 2 years, let's say. So the soft landing, or the coming off of heavy inflation, is not going to send us into a recession. It's going to be slow and steady until we get back to 2%. This isn't I'm not saying that. That's what Jerome Powell says. And Jerome Powell, of course, is the head of the Fed. A lot of Fed governors agree with Jerome Powell. Some say, hey, you know what? Maybe we got to raise the interest rate here at the Fed, the interest rate that we charge our member banks. Maybe we have to raise it rather than lower it. The economy has been doing very well over the last, 16 months or so. And what we see going into the presidential election is a pretty much holding pattern on a lot of economic indices. So we're probably not going to see the Fed do anything until after the election. We're probably not going to see the GDP fluctuate much more than it has been over the last 2 quarters. You'll end up, and I have a GDP outlook here, and I'll just get right to that right away. Let's see. So the GDP tracking, now we do this every month or so, and we go to 2 or 3 different sources to find out what they think the second quarter GDP is going to be. Okay, so the GDP tracking, Bank of America says it's 1.8%, Goldman says it's 1.9%, and the Atlanta Fed, which is always the most optimistic, is at 3%. So somewhere between 1.75 and 2.75 is where the GDP is going to land, and that means, as I was saying, the economy is pretty good, right? Everybody is looking at where we are and what we're doing. Inflation is drifting downward. We're going to have some revised numbers probably in before we get the new numbers out for June. And let's see, what is it, June 25th, June 26th today? June 25th, I think. Keep your job, and is this a good time to buy a house? All of these questions are answered, in my opinion, in the affirmative, yeah, and yeah. I think it's a great time to buy a house if you can find one. Now, inventory. The housing inventory is up 6.3% year over year, and that's a good thing. The actual numbers for the housing is, let's see it. I'll get the drum roll here in a second. Let's see. So, yes, the inventory is up 2.2% week over week and 37.7% year over year. Now, we all know that during the pandemic, housing inventory went to zip. As I said, we had interest rates fall down to 2%, 3%, 4%, and 70, 80% of the loans out there currently are under 5%. So you're not going to get a lot of turnover because people want to refi or take money out or get a better interest rate, or that it's a wash and they need the money because of whatever reason they need the money. They want to invest in something. They need somebody to send to college, maybe some medical reasons, all of these things being what they are. Most people are sitting on what they have as a mortgage. So when we see inventory increase, that's a good thing, because there's only 2 ways that people are going to be affording a mortgage today, at least typically a mortgage today. Either you're going to have the interest rates fall or you're going to have the home prices fall. And the only way you're going to have home prices fall is if you got more houses on the market. So we've seen some softening in certain markets around the country. Talked about it a couple of weeks ago when we had the show. We see here in Southern California, however, an increase but not a decrease, meaning that we'll see more inventory, but we haven't yet to see the crossover into lower costs for you to buy that house. Do I think it's coming? Yeah, I guess so. I mean, it's a guess from me, but I'm not the only one saying this. This is the National Association of Realtors, California Association of Realtors are talking about lower real estate prices, and as a result of rising inventories. Now, the rising inventories, it's always why are they rising? Well, it's because we're not getting enough buyers into the market buying property at their current values, so therefore, property is going to sit longer, and as the properties sit longer, you know what happens with prices. Prices usually come down. We're not there yet. We may see some of that towards the end of the summer, but of course, if you've got kids that got to go to school, your new job, you got to move, whatever that is, you probably already made your decision. You're probably already making your decision right now. It's the end of June. Summer just started. We're about ready to go into July, August. Those are the months that deals get closed. I mean, if you're in a situation right now where you got to move, the one good thing is that we see some softening in rents. So if you have to get out there and look at properties for rentals are not as high as they were, and they're not as skyrocketing as they were. The biggest component in inflation, as everyone knows, is the housing portion of it, what they call the, what do they call that? Unhoused, the housed section of it. So if we're looking at 5 to 6% rise in real estate rental prices over the past year, that's one of the bigger components, probably 40 to 50% of the inflation index. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to us on a weekly basis. We're at KCAA, the great folks over there, Fred and Mark and everybody else who's on the board and doing all the technical aspects. They have a great signal. It's on AM and FM, and we come to you on a weekly basis and have been doing so on Saturday and Sunday for close to a decade. So thanks very much for your patronage, for listening to us. And again, I am Jeff Barton. This is The Mortgage Voice. We are also on a number of different podcasts, and these podcasts are easily available, all the shows. We have plenty of archives. Daryl, do you have a list of that for us?
I sure do, Jeff. It's
Great.
Apple Podcast, Google Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, podclips.io, and themortgagevoice.com.
Excellent. Okay, themortgagevoice.com, as I said, is our what am I saying? It's our web address. It's our website. And if you go there, you can see past and present shows, as well as some of the guests have been on the show for many times, and some you may have not known about or how to get in touch with them. Anyway, you can do that now. Also, podclips.io, great central place for all your podcasting needs. If you, in fact, need a place to go where you don't have to search several different websites, as we just read off, podclips.io is a great place where you can find all your podcasting needs. Go there. I'm Jeff Barton. This is The Mortgage Voice. Once again, we have many different things in the news, kind of the news to use section. I'll just go through a little bit of it. Unemployment ticked up to 4%, as we said last month. One of the things about the economy, if we're going to see inflation come down, we have to see a bit of a hike in unemployment. And that's why we went from 3.5% to 4%, because employment rates as they are not employing enough people. Now, some people say this is a bellwether for gauging exactly where we are in the inflation fight. I think there are so. I was talking to Larry. No, I wasn't talking. I was listening to Larry Summers, who used to be the Treasury Secretary. I think it was under Clinton. Was it under Bush? Probably under Bush, right? He's a Republican guy. Anyway, so Larry Summers, smart guy, and he's really talking about why the inflation chase, i.e., are we going to see the inflation rate come down a lot quicker than it was? He was saying, no, probably not. He's saying the downtick last month in inflation had to do more with cyclical and monthly, not long-term. And the long-term strategy is probably higher for longer on rates. He's saying, let's not get into a situation where we lower rates and then have to raise rates again. And so he's much more of a conservative guy when it comes to look at that. So if he's saying, okay, I'm going to look at the unemployment at 4%, is that a good thing? Well, if you're an employee or somebody looking for a job, maybe it isn't. But we still have more jobs than we have people looking for jobs. So it's just a matter of fit. If your job that you're looking for is in that group that is available, then you're great. We also see a lot of participation in the labor force. It's summertime. There's a lot of part-time jobs. So because there's more people participating, that's another reason why the unemployment rate went up. Yeah, interesting stuff as well. Okay, so in an election year, we always talk about things that matter. Now, you and I don't know, I don't get that involved in politics. Some things make me mad. I can't go on X, I can't go on Facebook, I can't go on even LinkedIn, which I used to love all these sites because it was just random things you could find from different people, opinions. But now it's been taken over by a whole wave of you got to do this, you got to do that. This is the worst thing that's ever going to happen. The world's going to end. Now, it just really bothers me. So I went looking for some positive signs, which is what I like to do, of what's going on in the economy. Now, like football, like soccer, like basketball, I'm a Celtics fan. Celtics won the championship. Hooray for me, right? Why do I feel good? I don't know. I have nothing to do with that team other than I'm a fan. But it makes you feel good. So some of the things that make you feel good about the U.S. economy, and I wrote down several of these facts, and I don't know if it'll make you feel good enough to go out and buy a house, but it might. Okay, 4.3% of the world population lives in the United States. Okay, 4%, let's say 4%. 26% of the global GDP is in the United States. So you look at that number and you go, wow, So the rest of the world, which is 96% of the population, only has 75% of the GDP. So that's a good thing. It just talks about how the U.S. economy dwarfs every economy in the world almost to the point where it's not a comparison at all. $85,000 a year is the per capita income in the U.S. $85,000 a year. Just as an example, in India, it's $2,500 a year. In China, it's $11,000 a year. So you make these comparisons, and we always do, about the competition, about who's the best, and about where our money is going, and about how U.S. products aren't competitive. Well, you look at what the numbers are, you can say, wow, these numbers are astounding. And one of the reasons they're astounding is because of the character and the nature of who we are and what we do here in the U.S. in terms of innovation, in terms of production, all the things that we need in order to stay competitive. One of the articles I was reading talked about the bust and boom cycle. Now that's a very famous 50s, 60s, 70s, 80s, where one industry will just dominate for a while and then all of a sudden they're gone. Well, since 2000, the S&P 500, half the companies in the S&P 500 don't exist anymore. That's only in 24 years. So the idea that we keep recycling, or we keep innovating, we keep branding, bringing up and inventing new things and new ways to be able to dominate in certain ways. It's the character of the country, and I think whoever wins this ridiculous bandwagon of a circus election that we've got going, it's still going to continue that way, because it's you, it's me. I went from a guy who was a 25, 30-year person in the mortgage industry. I sold my company, 9 months ago, 10 months ago. I'm now in a completely different field and as successful as I was. Now, I think that kind of spirit is the kind of spirit that we need to more positively look at, rather than this person's taken from me, so we have to do something bad to them. That's just a personal opinion. I think there's opportunity out there for now. I'm lucky, right? I've got a lot of things going for me, and most prominently, it's age, experience, and money in the bank. And all these things are pretty good for anybody who's out there who has the same. But if you're young, if you're new, if you're looking for a house, housing is the best way to get into the game. 90% of U.S. millionaires did so through real estate. Okay, let's just move on. Housing is up 6.3% year over year, as I said, 37% more housing than there was last year. The Fed target rate next year. Okay, so Janet Yellen, everybody knows Janet Yellen. She's the Treasury Secretary for Biden and the Biden administration. She used to be the head of the Fed, right? So there's this long chain of very accomplished people who have been at the Fed, whether it's Alan Greenspan, or it's Ben Bernanke, or whether it's the current guy, Jerome Powell. Well, Janet Yellen wedged in there as well. She says that we will hit the inflation target of 2% in 2025. That's good news. All of these things are really good news. Consumer confidence, 100.4. It's down a little bit since last month. Let's see, U.S. oil, $81 a barrel. That's West Texas Intermediate. Now, oil this summer, it's always a thing here in California. We see prices go up and we wonder why. We not only pump oil, we refine oil. But most of the oil here in the U.S., in California, is shipped out of state. We don't consume our local oil. I don't know why, but that just seems to be the way the markets run. Auto sales, the slow second half of 2024, and that's probably due to the fact that, one, we have a great deal of inflation still in certain areas of the economy, and fuel is one of them, housing is another one, and new cars, there's another one. 15.7 million units this year. It'll be up 1.3% from 2023. And rates raise, that's what Fed Bowman says. He's one of the Fed governors, and he says that the rate for which we charge member banks, the Fed may raise rate in order to keep inflation fight going. I don't think it's a great idea, just because I think not only do equities in the stock market get killed, but anybody who's got a 401k or any other kind of long-term retirement, that's not a good thing. I'm Jeff Barton, your voice in the mortgage industry. We got a big show for you, and I'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis as we bring to you the best and most current information about what loan products are out there, as well as an update on real estate, some of the goings-on in the economy, certainly anything that'll get your eyes off the ball of buying. And then in this silly season, there's a ton of them. But refocusing, looking at what's available out there and taking advantage of every situation. As I said, inventory's up, and we're really happy about that. But we need to see prices come down, and we need to see a little bit more steady look at long-term interest rates. But I'm not the person to do that. As I always say, I bring the best people on the show, and Tomas Trujillo is no exception, been on the show many times from Jet Mortgage. He joins us now to help answer these questions. Tomas, how are you?
I'm doing great, Jeff. How are you today?
I'm okay. As we were talking off air, I'm hot. I don't know about you, but it's hot. Oh, man.
It is hot. It is hot.
You know, it's funny. It happens every year. It's freezing in California. California is one of those funny places, right? Sometimes in the summer, if you're in the shade, you're cool, and it could be 102 out. It's just a weird place that way. But where do you see where we are? And let's say I'm a first-time home buyer, and I come to you and I say, look, I've got, $100,000. I want to buy a house. What kind of loan product? My FICO score is not that great. What do you suggest to people when they come to you like that? I'm sure there's plenty of them.
There's plenty of them, and the first thing I'd always tell them is, because the first thing I hear is, oh, the rate. Oh, my God, the rate. And I tell everybody, look, if you wait for the rate to go down, you're never going to get a house, because as soon as those rates go down, those prices are going to shoot. Right. I mean, people back in the 70s, I remember my father, he was doing the same thing. Oh, the rate. I mean, back then it was 20%. And
exactly.
It was 20%, 5 points, and that's what you paid. But okay, the houses were lower, but so was the income.
Right.
So
that's right.
One day he was like, well, I said, well, are you going to buy it, Pop? You going to buy it? He said, well, son, I'm only going to get more money on this thing. The thing's going to go up in value. One day the prices, the rates might come down. Everyone gets cheaper. And he was right. Now that $100,000, 30,000 square foot house is worth $1 million. He bought it for $150,000. So I tell everybody, look, if you're ready to do something, then you got to do it. You got to do it now, because you can always renegotiate the rate. You're never going to renegotiate that price.
Yeah, I agree. I 100% agree. And with rents being what they are, I mean, if you look at your rental and you could make that payment to a mortgage, wouldn't it be better to do that with a mortgage, even if you had to pay a few more bucks?
Oh, 100%. Actually, my mortgage, people that are around me pay more in rent for the same house or smaller than I do in a mortgage payment. It's ridiculous. And so going back to your question, what do I tell somebody? I want to get going. I said, yeah, let's get going. Let's get together. Let's get the most that you can afford in the best neighborhood you can afford, because when that thing goes up, you're going to start making money, and this thing is going to pay for itself in a couple of years.
Yeah, I agree with you. And as you said, rates being what they are, they've really remained for the past 90 days pretty close to what they are today.
I mean, I don't think they're bad. I mean, but then again, I came from a place when it was 20%, and
No, that's true. But I mean, let's say you got a 30-year fixed at 7%. Or thereabouts, 6.5% to 7%. That's still not so bad.
Oh, that's not bad at all. We were selling that back in 2005, right when it was the hot market.
Right.
That was the going rate. I mean, a couple of years ago, we've never seen a 1% rate, a 2%, a 3%. I mean, that was great if you got in, but I mean, it's not realistic. I don't think it'll ever happen again. But who am I? Who do I know? What do I know?
Well, interesting you say that. So these mortgages, which are about 80% of people who have a mortgage, is under 5%. Do you think this wash-through rate is going to increase the further away we get from COVID? Meaning that people will finally say, hey, you know what, I need the equity in my property, or I got to sell, or, because 80% of the houses out there with a mortgage under 5%, nobody's going to go anywhere. I just know the way people are. Things happen, they need money, or they sell, or, I just
100%.
don't know when that's going to happen, and I think everybody's waiting around for that to happen.
I think you're 100% right. I mean, I've already seen it happen. It's already happening.
Yep.
It's been happening. People are getting divorced. People are passing away. They got to do something. So yeah, they're selling the house. They're refinancing the house. They got to buy. They got to pay tuition. They don't have enough money. They came up short. They got to refi the house, get some money out. But here's a good intro. That's why we do seconds. We're doing standalone seconds where you don't have to touch your first. Take the seconds. Pull the money you need, and we'll go to $600,000 on a second. We'll do a P&L only loan on a second, which is pretty damn good. A P&L only loan for a second.
Explain it. Tell people what the P&L is. What are you talking about? Because a lot of people who have equity in their house, they don't know from second versus P&L versus full doc. They don't know.
Sure, I get that. So if you are a self-employed borrower, or if you have a side gig, if you have a side business, if you sell T-shirts at the swap meet, you can use that income. You may not report it all, and that's fine. I'm not asking you to. I'm not asking for proof. I'm not asking for a 4506. I'm not asking for tax transcripts. Give me a P&L from your local neighborhood tax preparer. Doesn't have to be a CPA. He'll say, hey, my client, Roy Jr. here, he makes $100,000, and he only waives 20% of that to keep the business going. And he's been doing it for 2 years, and that's all I need. And you're getting a loan.
Okay, that sounds good. And you set up to $650,000. What's the FICO score they need?
That one would be a 660.
Okay, so you're not trying to kill people on the FICO score either. 660s, I would say most people have at least that, if not better.
Yeah, it's not that bad. I mean, if the better the FICO, obviously the better the rates.
Absolutely. Okay, so this second, how popular is it?
It's pretty popular. Right now, it's a really hot product. It's like you were saying, nobody's going to touch the rate under 5%. Right. It ain't happening. I mean, one of my best friends has a 1% rate, and he needs money, so we did a second for him because there was no way he was going to touch a 1% rate.
Nope, not on your principal. Why would you? That's silly.
Yeah, I mean, he pays double the payment, which turns out to be what he used to pay prior to refinancing. And he'll have his house paid off in 15 years, and it's a 30-year loan. How do you go wrong?
I totally agree. Assumable mortgages. Do you think any way that we'll see those come back into the marketplace because of the rates being what they are for these low interest rate loans that people have? You think there'll be any way that they'll be able to assume that loan if they sell it to somebody else, or the new buyer will be able to assume it? Do you see that?
I would love to say yeah, because that used to be a big thing back in the 80s.
Yeah, it was huge. 80s. Right.
Everybody was assuming, but then lenders started saying, wait a minute, I'm not getting paid out. No, I don't want to do this. I don't want to do that. Even Cal Hassel, which used to be assumable, they're not assuming them anymore. So I don't see that coming back anytime soon. So you never know.
Yeah, you never know. Well, you have your ears to the ground, and you've been in the business a long time, just trying to find solutions to the housing crisis. Do you think it's pretty much hands off? The government itself is not going to do anything unless it's a down payment assistant or some other type of program like that. They're just going to leave it the way it is and see what happens.
The whole thing it's different. It's totally different. Before, in an election year, you knew the rates were going to come down.
Right.
You knew the economy was going to be booming. You knew you were going to have a great year. But it hasn't happened this year, which is shocking to me. It's shocking to everybody because we thought we were going to have a bunch of rate drops, but
we did.
We never had any of them. And now they're talking maybe September, but I don't think so. I don't know.
Before the election, I don't think so. I think they're going to be hands off on this thing. It's sort of quietly not doing anything. As I was saying earlier in the show, I think after the election you might see some movement, right? It really depends on what inflation does. But in listening to some of the economists talking about, hey, why are we going for 2%? Why don't we go for 2.5% as the bottom line figure that we need for inflation? I mean, before COVID, they were talking, they wanted to get it back up to 3%. Now it's 2% again. It's just very confusing as to why that's the magic number.
Honestly, I don't even think that they know.
Right.
Everybody's guessing. Who knows? I mean, before, if the bond went up, you knew the rate was going to go.
Right.
If the bond went down, you knew the rate was going to. I mean, we all knew, we all had indicators, and we knew we
right.
needed to float. It's not like that anymore. I mean, the bond can go up, and now the rate goes up, and
yes, it makes no sense. Tomas, thanks for coming on. Listen, could you shout out a way by which people can get in touch with you about this great second loan you have?
Absolutely. Well, my name's Tomas Trujillo. You can always get me on my cell phone at 323-228-5181, or you can always email me, and I am the Big Bad Loan Daddy at gmail.com.
Excellent. Thank you, Tomas, very, very much. Appreciate you coming on, as always.
Absolutely. Thank you, Jeff.
Thank you very much. That's Tomas Trujillo from Jet Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show and listening to us each and every week. We bring to you information, good information. Some of it's not great information, but I didn't originate it. It comes from what's happening in the economy, what's happening in real estate, mortgages, the rates. Actually, the rates aren't as bad as people say. All you have to do is look back several years and say, hey, 6.5%, 7%, not bad, really. What is bad is limitations on the availability of property. The cost of some cities is way, way, way out of range. I read an article today, said that 5 of the top cities that would probably see a fall in real estate prices over the next 5 years. Now, of course, this is what if, but Los Angeles was number one. One of the cities that didn't come up was Las Vegas, Nevada, and one of my friends and person that has come on the show many times, Jennifer Conrad, who works over at Malibu Funding, has graciously acquiesced to come on the show once again. Jennifer, how are you?
I'm doing well, Jeff. Thank you so much for having me back.
Thank you, and thank you very much for coming on the show. Okay, so with that long-winded intro, tell us what's happening in Las Vegas. We haven't had a interview with someone out there. We used to have a station that we were affiliated with out there. But tell us about the Las Vegas market and what kind of loans you're doing for customers who are needing someone to give them a loan.
It does seem like a lot more people are interested in purchasing. Right now I'm doing a lot of investment purchases. So it almost seems like a lot of people are maybe trying to purchase to either have as like an Airbnb or condo-tels, something, it's going to be a short-term rental, since there are so many people who want to visit, and spend time there. I'm doing a few second homes, but the bulk of it is pretty much condos. And if you look around Las Vegas, it looks like there are so many condo units that are going up. So obviously, they're catering to the fact that seems to be the interest that people are kind of steering towards.
Do you see now in certain states like California with the wildfires and down in Florida with obviously the weather problems they have down there with hurricanes and that kind of thing affecting homeowners insurance, is there such an issue out there in Vegas in terms of the heat or any other natural thing that might make price of either your insurance or the condo itself go up because of the heating and the air conditioning?
I can't say that I've experienced that per se. I've spoken with people and then I've gotten quotes myself. I guess a lot of it might have to do with if you're dealing with certain companies that have a lot of carriers in the area. I mean, relatively speaking, when you compare it to Florida,
right?
Where I saw one that was $7,000 last month, or California where I've seen one for $5,000.
Right.
Yeah, it's definitely not that.
Right.
But then again, too, when I'm focusing on people purchasing condos, then we have the master policy that's covered by the association, and so borrowers are basically just getting coverage, for the interior walls and their own personal items. So that's a fraction of the cost. Okay,
very good. No, I know insurance in those areas that I mentioned is making the cost of the condominium really reflect the fact that getting homeowners insurance or the HOA insurance that then you get assessed for has been a real problem. But I'm glad out in Vegas it hasn't been.
No, I haven't experienced that so far. Hopefully it stays like that.
No, exactly. Okay, tell us some condo loans. What are they selling for, and what kind of terms are you getting?
Right now, I'm seeing things, between like $285,000, 310. Single family, in certain areas like Rhodes Ranch may go more like, 525, somewhere in there. And what I do notice is that the HOA fees are considerably less than when you consider California.
Of course, yeah.
A lot of places in California, you're looking at 500 to start, on assessments. And you can find places in Las Vegas, 225, 250, somewhere in there, nice places. So, yeah, I think a lot of people are interested in trying to make a transition to that area.
How do you like the actual living in there on a day-to-day basis?
I love it.
Okay. Okay, no, I mean, hey, I'm glad you do. I happen to like Vegas a lot. I don't know if I'd live there just because I can't take the heat, but air conditioning being what it is, it's pretty good still,
Well, I do feel like that maybe there's more of a focus to make sure that you have central air and that it works well there, maybe more so than in California. It does feel like it's extreme heat, but
right.
I guess a lot of that, too, is, just kind of planning your day to make sure, you're not out in it, but then are able to get out and enjoy either early or later in the day. So I guess, anywhere you live has, its positives and its drawbacks, and it's just a matter of, how we approach it. So,
have you seen a difference between pre-pandemic and now post-pandemic in the way buyers approach loans themselves? Is it the same issues and problems that you might have trying to ask a buyer for certain documentation, or has there been an education or a lack thereof an education in terms of the buyer you're seeing today? I'm just trying to get a feel as to, yes, you've been in the business a long time, and not only as an originator, but you also do a lot of processing, underwriting for different lenders. Have you seen a difference in the profile of the borrower then versus now?
It does feel like there are more people needing a down payment assistance program. I think there have been some people who did not realize, and maybe none of us really knew, with some of the lenders putting things into place like, you could delay making a payment, for a year, and then being in situations now where some lenders are actually saying that is an issue with you being able to refinance. As far as like purchases, there seems to be a drive of, I remember you might see one or two lenders that offered a down payment assistance program, and now it feels like every lender has that, but it also feels like a lot more condo projects are not FHA approved. Obviously, if you are buying a single family home, then you can use those programs. And it feels like the buyers are more aware of the fact that they have down payment options.
Right.
And so they want to utilize those. They come in kind of letting you know that that's, what they want to be able to use.
Are you running into any problems with realtors, being that they had that lawsuit and now it looks like the buyer's agent can't necessarily use the seller's commission in order to get paid? Are buyers looking for experienced people to help them? Like, for instance, you're on the mortgage side. Are they asking you real estate questions now more than they used to?
I can just say that I ran into an agent that was in the Midwest, and I really had to educate her on every aspect of, making sure the condo project was FHA approved, explaining what certain terms were regarding earnest money, everything, until I had to question, how long have you been doing this? But in regards to, questions regarding their commissions or how they're affected, no, I've not experienced that. So I'm assuming that's something that sort of gets worked out before it actually gets to me.
Yeah, well, I was just wondering if a lot of the burden of, as you were just explaining, education of the agent or just letting them know exactly how things work in certain areas. Used to be when they, were paid a little bit more, you'd get more experienced agents, but now those agents are no longer doing that kind of work because you don't get paid automatically. You'd just be a listing agent and that's it.
Yeah. Well, I mean, I think it's always been a situation where we were sharing information, but I can't say that, I've had, like I said, that one particular experience. Mm-hmm. But I do find that there are loan officers, if I am processing for them. There are loan officers who probably could stand to, brush up on some education because there's a lot of things that they don't seem to know. And I don't know if maybe it's because, on the processing side, you're sort of in it all day, every day, and so you're exposed to more things to understand how things are changing. But, so I guess, being on this end, sometimes you're kind of educating loan officers and dealing with real estate agents, experienced or not, and just kind of sharing information and bring them up to speed.
Yeah, no, I see that. And obviously, as you fight to close loans that you've had in the pipeline for a long time, or they're done very quickly, are you seeing any difference in the tightening or lessening of lender guidelines over the past 6 months or so?
I don't think it's any more relaxed.
Okay.
I would say that. I do think that, when you're looking at things like, borrowers who have high credit scores who are, putting down 20, 25%, we're getting more, at least I am getting more property inspection waivers, even on purchases. And it used to be a time when, it was seldom that you would get something like that on a purchase. And I know I've had 3, just last week alone.
Wow.
So I think that has a lot to do with the profile of the borrower, but then you have other people maybe who have a few more credit challenges, putting a little less money down, and it does feel like, those files are scrutinized a little bit more.
Oh, excellent. Listen, we've come to the end of it. Could you do me a favor and let people know how they can get in touch with you? A terrific loan officer in many states that you can do your lending. You're currently doing some in Las Vegas today, but shout out your number. Let people know how they get in touch with you.
Thank you so much. My number is 773-593-6831. Again, 773-593-6831.
Jennifer, thank you so much for coming on. Once again, saving the day, doing well on the show. I appreciate it very much.
Thanks, Jeff.
Thank you very much. That's Jennifer Conrad from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis, bringing to you information that you can use right now, today. You can size us up, kind of fit this into what your box is in terms of borrowing and going out there and buying a home. Although prices are high, yes, they are high, and the rates aren't the most friendly, but they're not the worst either. Anybody that's older than 5 years old will tell you, 6, 7, 10 years ago, even early 2000, prices were high. So this is a great opportunity for you to get out there. One of the best people I know who helps us always discern that from what other noises there is in the marketplace is Charles Giscombe. He's from USF, and he joins us now. Charles, how are you?
I'm doing great, Jeff. Thanks for having me again.
Thank you, too. Thanks very much for coming on the show. So what's happening in your neck of the woods? Tell us a little bit about some of the borrowers you're dealing with and some of the challenges that may be a little unusual this time of year. It's summer. It's hot. People get a little squirrely, and, there isn't that much inventory.
All of those things are true, Jeff.
Yeah.
Everything. But what we're dealing with is we see a little bit of adjustment in the interest rate. I think a 30-year fix right now on the average is about 7.
Right.
A refinance mortgage might be a little bit lower, maybe in the high 6s, 6.95, 6.96. And, the jumbos are about 7.5, 7.375 to 7.5 and above. So at the end of the day, interest rates aren't great. They're better than they were, but they're just lingering around, where we've been for the last couple of weeks.
Right.
What I do know is that because of the inventory, it's not because of the rates. It's because of the inventory. It is, people are rate conscious, but, what I like to tell them and what we always talk about here is there's different value-added services that we can add to your loan to offset the interest rate.
Right.
At the end of the day, if you are not looking to keep your home for 30 years, which I don't know who else looks at that anymore, and that is, let's do an ARM, adjustable rate mortgage, or we'll get you a lower interest rate, or let's do a longer amortization period. Instead of 30 years, let's go to 40 years. Both of those strategies allow you to get lower interest rates, mean lower payments as far as the ARM is concerned. And for the 40-year loan, it allows you a longer period of time. You're adding 120 months to an already 360-month loan term, which allows the payments to be stretched out over a longer period of time, which obviously makes your monthly check stroke lower. That's what we've been using lately to offset the higher interest rates that people have been so spoiled but not used to seeing. Because one thing I tell people is the lower interest rates may never come back, but the interest rates will adjust themselves and get lower.
Well, I think what most people don't realize is that we're 2 years away from those low interest rates. It really hasn't been that low for, like I say, 18 to 24 months. And as we get further and further away from that time period, people get used to the normal and say, yeah, we can afford it or we can't afford it. I just think the house prices are so high. I was just talking to another guest on the show, talking about stuff out in Las Vegas. Now, the prices compared to, hot markets like Los Angeles, obviously are much, much cheaper. How are the house prices in some of the areas where you're looking at doing loans or doing loans currently?
Well, you know what? The house prices are relative. I mean, the value is kept, like in Charlotte and Georgia.
Right.
Those places are going to keep their value. There's going to be a lot of people transaction. And quite frankly, when I'm talking to these individuals over here, Jeff, I pretty much just tell them, listen, mortgage rates have been volatile and remain high. And according to, all the different Freddie Macs and Fannie Maes,
right.
They're going to hover around 6.8% for this week. And we should not expect them to decrease significantly anytime soon. Like Jeff said, at the end of the day, it's just if you got a good deal, you create a short-term strategy and know that at some particular point in time, like when Jeff says in the next 18 to 24 months, when the rates do readjust, in 2025 even possibly, they may fall below 6%, but they may not. But
right.
if you have a great deal, what you need to do is you create a short-term strategy and a long-term strategy. As long as we can see our way through to getting to a property that is going to show an upside for us, then we can create that short-term strategy. And then, hey, listen, long-term is we're going to get into that lower interest rate when they correct themselves. We'll fix it then. Right now, we should just be concerned about a good business transaction and look at those terms. More importantly, loans that don't require a prepayment penalty so that when we have to flex and react and adapt, that we have the ability to without costing us any money.
Well, yeah, the prepayment penalty, now that still exists on some loans, but not on the loans that we're doing, or at least you're doing with the non-QM stuff, right?
Correct. On the non-QM thing, Jeff makes a great point. There are a couple different things that help us out in this loan. There's no prepayment penalty, so you can refinance at any particular time with no penalty. Also, regardless of how high the loan to value is, the LTV, there's no mortgage insurance. So that's a great benefit too.
Right.
If you can get into a property that's above 80, 90, 95% LTV, there's no mortgage insurance for these loans. And obviously, they are the path of least resistance. They don't require traditional structure and documentation. And what I mean by that, for the people that don't know, a traditional mortgage is going to always ask you for 2 years W-2s or tax returns.
Right.
It's going to always ask you for 60 days of bank statements, 2 months complete. And they're going to always ask you for 30 days worth of payment history, paycheck stubs, whatever. If you get paid every 2 weeks, once a week, they're going to ask you for that. That's the traditional financial documentation that it's going to require to get you qualified for a loan on a traditional loan. What I mean by traditional is Ginnie Mae, Fannie, Freddie, USDA. All those loans are going to require you to have that traditional financial structure. The non-QM loans that Jeff is referring to, non-qualified mortgages, have alternative documentation, and they will require you to have bank statements for 12 months, 24 months. They'll allow you to do a profit and loss. Different loans like that will allow you to get in without traditional structure, and they also have those value-added service we talked about. No prepayment penalty, as well as no mortgage insurance for a higher LTV loan.
Do you find that lenders themselves are tightening or loosening their guidelines, or is it basically a split down the middle, whereas you'll have your non-QM, as you just described it, and your more traditional agency or 30-year fixed-rate Fannie Freddie, maybe they are a little bit tougher to get?
Some may be a little bit tougher. And if you're dealing direct, and what I mean by direct is if you're, United Securities Financial is a Fannie, Freddie, Ginnie seller servicer.
Right.
A lot of times when you're a direct seller or servicer that way, you don't have the overlays that the other broker situations or banks have. So you can be a little bit more lenient and flexible in regards to your underwriter manually underwriting a situation and just making sure that, obviously there's other concessions that we can make to qualify some loans. A broker that is taking somewhere, they may not have that flexibility because there may be some overlays. If there's some credit issues, some previous credit events that occurred, if the credit score is lower than usual, there's certain things that will that will tighten up that lenders will not be lenient upon and need a certain FICO score in order for them to qualify that loan and sell that loan. So what I see is that the non-QM is already a little bit more flexible. Will offer you probably a lower, a lower tolerance for the documentation.
Right.
But I will say there are some traditional loans, FHA loans, VA loans, that only require you to have a FICO score sometimes only at 580 or 550. You can still get those loans done. So sometimes you trade off the benefit, and that is if you have a low FICO score, but you have traditional documentation, you can provide those documents that we discussed. That's still a good loan for you because it also is a lower down payment loan for individuals who make good money, who are paying their monthly bills, but just may not have enough money to save enough for a larger down payment. These loans are super beneficial and super helpful for individuals who can qualify in the traditional box. But if you have the other documentation and have a little bit more down payment, non-QM may be the way to go.
Excellent description on the way you look at, and the same way I look at the non-QM world as well. We've run out of time, unfortunately. We'll have you back, as we always do. You're our favorite go-to for this kind of information. Charles, could you let people know how they may be able to get in touch with you, terrific loan officer, help them get a loan?
Thank you, Jeff. You can get a hold of me at area code 725-577-8761. That's 725-577-8761. Or you can email me at cgiscombe@usfwholesale.net. That's cgiscombe@usfwholesale.net.
I love that, usfwholesale.net. Excellent. Okay, thanks, man. Thanks very much for coming on the show.
Thanks for having me always, Jeff. Pleasure.
Thank you. That's Charles Giscombe from USF. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next week.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
News, weather, and talk from KCAA, broadcasting to the Moreno Valley, Corona, and River.